Very good morning, friends. So I hope you're doing well and your revision is also going great. Well, in the last session, we started with the topic on financial instruments. We've already covered a revision on Index 32, and we also started a focus on Index 109. And we've covered the initial part of 109, which of course is the main core part of the standard, wherein we saw the accounting in terms of financial assets as well as financial liabilities. I gave you some quick mind maps as well, where we looked into the initial to the subsequent accounting of all the categories of financial assets and financial liabilities. But I think before we go further in terms of accounting of financial liability, because I don't remember doing a question on financial liability accounting, though conceptually we made a revision that they measured at AC or at FPTPL. There is of course no category in terms of FPT OCI as far as financial liabilities are concerned. But before that, there is one very important issue which invariably comes a lot in the exams, and that is when you recognize your financial assets, they're recognized at a fair value. And there might be a difference in terms of the transaction value and the fair value. The question comes, how do you tackle the difference between the transaction value and the fair value at the time of initial recognition? And there are a couple of situations which arise. I think we're going to make a mind map after we're done a few questions on that. Though I would say typically there are three cases which we look into when there is a difference in a transaction value and a fair value. So I think the first one we're going to start is with the concept of a concession loan. When the employer gives the employee a loan below a market rate of interest, we know it is called an off-market transactions, and that gives rise to, you can say, a perquisite value. So how do we tackle all that? Let's, I think, have a look at that question. So I'm going to come to now the focus area, transaction value vis-a-vis fair value differences, how they are accounted for. So let me, I think, share the question to you on the screen. So we're looking at the question number 8, which is pertaining to the concessional loan. Let's, I think, read the facts of the case. It's a November 2020 examination question. So I think first thing which I always tell people, if you see the question, a larger question, then I think it's always better to first look at the requirement of the question before you proceed. So I think let's have a look at the requirement of the question. You're required to explain how the housing loan should be reflected in the Ind-AS compliant balance sheet on March 21. So I think now let's read the facts of the case. We know very clearly that it is talking about an housing loan. It says on 1st April 2020, S had advanced a housing loan 15 lakhs to one of the employees at the interest rate 6% per annum, which is repayable in 5 equal annual installments along with interest. Now, this is one place I see, many times students tend to get confused. So is this equated installment? Is this including the interest that we're going to pay in 5 equal installments? Or is he talking of the principal portion being paid in 3 equal installments? I think you need to be careful with the language of the question. It very clearly says that it is 5 equal installments along with. When the word is used along with interest, along with is indicated as a plus. So once it says that there are 5 equal annual installments, I think it is pretty clear we're talking in terms of the principal amounts being equal. So we're going to pay that 15 lakhs in 5 equal installments, that is 3 lakh plus the interest. It says the employee is not required to give any specific performance against this benefit. And then it says the market rate for a similar loan on the housing loans by the bank is at the rate of 10%. I think one thing is very clear. As you see, the contracted rate of interest on the loan is 6%, and the interest rate on a similar loan in the market is 10%. So that proves that it is off-market transaction. And the moment you see that it is supposed to be an off-market transaction, we know that it is going to be a case where the transaction value and the fair value undoubtedly is going to differ. I think it's not too early, but I think let me also ask you a simple question. If this is going to lead to a difference between a transaction value vis-a-vis a fair value, would you like to tell me where are you going to post the difference? Because when you could put the entry that is financial asset gets a debit, that would be fair value. And when you record the bank, that would be the transaction value. So where would you take the difference between a transaction value and the fair value? Think about this. Let's, I think, take this further. It says the accountant of the company recognized the staff loan in the balance sheet equivalent to the housing loan disbursed. So what the accountant did, he made an entry at the transaction value itself. Undoubtedly, it's not correct. The interest income for the loan is recognized at the contracted rate in the statement of P&L. That is, he took 6% on 15 lakhs, that is 90. I think that is also incorrect. Because when you go to consider the interest is not going to be accounted at the contracted rate of interest. It says analyze whether the above accounting treatment made by the accountant is in compliance with the relevant Ind AS. If not, I will always tell people, that when you read the question, many a times the requirement, the input in the question is telling you what is incorrect in this question. It very clearly says whether the accounting treatment is correct or not, and if not, that is implied it is definitely not. Advise the correct accounting treatment for the housing loan, that's 1. The interest, that is 2. And other expense, that other expense is nothing, but it is going to give rise to the difference between the transaction value and the fair value is going to give rise to the other expense. In the financial statements for the year 2021, along with the workings and applicable Ind AS. And of course, we already read the requirement. You need to explain how the loan is to be reflected in the Ind AS compliant financial statements for the year ended March 21. Okay, my question I think still remained. I was waiting for your inputs in terms of how do you treat the difference between a transaction value and a fair value. I think I got no inputs on that. That in terms of the concession loan, where are you going to park the difference between the transaction value and the fair value? I'm still waiting for that. In the meantime, let's do some calculations. I think the first focus point, which should come to your mind at this stage is, we know that financial assets are always recorded at a fair value, except the 2 exceptions which we discussed last time. There is a loan recoverable on demand, and there is supposed to be a trade receivable. Other than that, all the financial assets are taken at a fair value. So even in this particular case, when you're looking at the concession loan, your initial recognition has to be at a fair value. So your first focus point has to be to calculate the fair value of this concession loan, and we're accounting in the books of the employer. And then the second focus would be to compare the fair value and the transaction value, get the difference and decide where are you going to account the difference. And of course, that is going to depend upon the nature of the transaction, which I'm yet to discuss. I'm yet to get your inputs on that part. So I think let's begin with the first input. So we are on question number, I guess that was 9. Let me just quickly take the number, question 8, sorry. So we're looking at the question number 8, where we want to first of all calculate the fair value of the loan. That is the first key focus point, that you need to organize the fair value of the concession loan. Now, when you go to calculate the fair value of this concession loan, what is important at the back of the mind is we organize, number 1, all the inflows, and then take the present value of all those inflows at the rate of interest which prevails on a similar loan in the market. So we need to first of all organize all the inflow. Now, I've just kept the question in front of me. November 2020 examination question. Now we are given first of all that this loan is supposed to be paid in 5 equal installments. So let's organize the year number. Let's consider the principal collections and let's consider the interest collections. We get the total cash inflow, take the discounting factor, and we can get the present value. So let's organize the information. The focus is to calculate the fair value of this particular loan. Okay, so in this particular case, number one, we can clearly see that the principal amount is paid in 5 equal installments. We've already calculated it is 3 lakh. So we take this 5 years data and the principal amount is supposed to be 3 lakhs. So this is the principal amount repayment. So collection for the employer. Now, when you calculate the interest, I think the best way to calculate interest is you take the interest for the first year and then you can easily do the calculations for the next 4 years to go. Now, the interest is contracted at the rate of 6%. So on 15 lakhs, if you take a 6% interest, it works out at 90,000. This is for the year one, that is 90,000. Now, what you can do? Since the principal repayment is taking place in 5 equal installments, can I say your interest will also get reduced 1/5 every year? Just go with the logics that if the principal repayment is getting reduced 1/5 every year, so would the interest as well. So what we can do, we reduce 1/5, that means 18,000. So keep making a reduction of 18,000 every year. That becomes 54, that becomes 36, and that becomes 18. So this is the principal and the interest collections by the employer. And now we need to consider what is the total inflows. This is 390. This is 372. This is 354. That is 336. And this is 3,18,000. So this is the total cash inflow for this particular loan. And you need to consider a discounting rate which is 9%. The rate of interest which prevails on a similar loan, that is the market rate of interest. And that's clearly given in the question. It is prevailing in the market, sorry, not at 9, I think it's 10%, I'm afraid. So this is at the rate of 10%, that is the market rate of interest. I think I'll avoid doing the calculations in this case, directly give you the present value. I hope that works fine. You can keep, doing your calculations on the present value factors at 10%. I'll just give you directly the fair value calculations. This is 1354. This is 1354,602. That becomes the present value of all the future cash inflow, and that is what you can call it as the fair value of the loan. I still didn't get any inputs on my question, which I have asked a couple of times. What are you going to do with the difference between the fair value and the transaction value? Okay, so I think with this inputs now, we come to the second focus point. That's the only crucial point to be discussed now. So we know that as far as the transaction value is concerned, that is the loan value, which is to the extent of 15 lakhs. And we've already made the calculation of the fair value. That is supposed to be 1354,602. So we take the difference between the two, which is to be accounted for separately. So this difference is coming to, I guess, to the extent of 15 lakhs minus 1354,602, 145,398. This is the difference. It's an off-market transaction resulting in a difference in transaction value and a fair value. Surprisingly, I think I didn't even get a single answer how you go to account for this difference. Oh my God. So I think it's time for me to give an answer now at this particular stage. Since in this particular case, it is a concession loan, the relationship is between the employer and the employee. this is going to be taken as a prepaid staff expense. And then this prepaid staff expense is going to be amortized over the period of the loan, that is straight line basis for a period of 5 years. Because indirectly you can say this is more like a perquisite value, because when you're giving a loan to the employee where the market rate of interest is 10% and the contracted rate is 6%, you're doing a favor to him. And that favor is nothing but it is indirectly a perquisite value. So this is going to be taken as a prepaid staff expense. So this difference, let me put it like this, it depends upon the employer-employee relationship. The transaction is you can say a part of the employer-employee relationship. So this concession loan is going to be taken as a prepaid staff cost. This is going to be called as a prepaid staff cost. And that's the reason the question is very clearly telling us that you need to attribute the other expenses also. So I think we're ready now. Now the accounting is going to be pretty simple and straight. So what do we need to do at the inception? If I were to now look at the entries at the initial stage, we can say the loan, that is the financial asset, gets a debit. The financial asset will be recorded at a fair value, and which is to the extent of 1354,602. And then you record the bank. The bank will be given a credit to the extent of transaction value. And the difference, as we've identified, is the prepaid, you can say, staff cost, and that is to the extent of 145,398. So this is how the journal entry will look at the initial recognition. The question is also very clearly asking us, it says, you are required to show how the loan would appear in the balance sheet on March X1. Now, this is not on March 21. This is the entry which is done at the beginning of the year, that is on 1st April. And I think worth making a mention, which we're going to show the accounting as well. This prepaid staff cost is going to be amortized. It is going to be amortized on straight line for a period of 5 years. So we're going to amortize this for a period of 5 years. That's how the accounting will be done. Now, the examiner is not asking you to do the entire accounting for a period of 5 years. He's only asking you to give the information for the first year itself. So I think what we can do, we can make a leisure account for the loan, that is one for a period of 1 year. We can make a prepaid staff cost leisure for a period of 1 year, and then you can organize the information which is going to be reflected in terms of balance sheet. You know, when the question says that you need to reflect the information in the balance sheet, it is very important that you also tell the examiner that which information is current or non-current in nature. The focus is in terms of not only, you get the information through entries or charts, whatever is comfortable, and then you should organize the information as per the requirement of the question that, okay, I need to organize that this is the finance charge in the P&L, this is the amortization of the prepaid staff cost, this is the value at which the loan would appear in the balance sheet, is it going to be current or non-current in nature, all that information. So let's make a ledger for a period of 1 year. So in this particular case now, let me just make a ledger. I always prefer to make a ledger account. You can make an amortization chart as well. That's your personal choice. But I think the ledger account is always easy to make. And I think it gives us the information quickly. You keep a track in terms of your opening, closing balances, etc. So let's, I think, work this out. So I am going to first take the loan account, which is the financial asset. And this is to bank. And this is with the fair value which we have taken, 1354,602. So this is 1354,602. And we also consider the prepaid staff cost. And this entry will also be posted from the entry 145,398. 145,398. That becomes the prepaid staff cost. Now, what we need to do in this particular case, let's first concentrate on the financial asset account. And in this case, first we take the finance income. I think worth putting a question around, are you going to take the interest at the rate of 6%? Or are you going to consider the interest at the rate of 10%? We're indirectly doing unwinding of discount. Initially, you consider the present value of all the inflow. Now you're going back and doing an unwinding. So would this be taken at what rate? Can I say again, at the market rate, which is supposed to be 10%? And that works out at 135,460 approximately. And then we receive the interest as well at the end of the year, which is of course on the contracted rate. So we've seen on 15 lakhs, there is a 6% interest which is received at the contracted rate at the end. And we can get the balance CD as a balancing figure in this ledger. So 1354,602 plus 135,460 minus 90, this works out at 14 lakh 00062. That becomes the closing balance in this case. Okay, so this is done. I guess, okay, sorry, there was a principal repayment as well. We forgot to take the principal repayment also. That is another 3 lakh. So this will become 11 lakh 00062 becomes the closing balance. Okay, now I think I have a small little question to ask you at this stage, which is, I think, very important to ask. Is this financial asset going to be reflected as a non-current asset in the balance sheet? Of course, it is a financial asset, but even financial assets are, segregated in terms of current and the non-current portions. So are you going to reflect this figure as a non-current asset in the balance sheet or partly between current and non-current? I think let's get that information from your side. So what do you say? Are you going to show this amount as non-current in the balance sheet? Or is this going to be split between the current and non-current? Remember one thing, that there is a certain amount which is going to be payable within a period of 1 year. Because you are making a repayment of the loan in 5 equal installments. So is this going to be totally non-current or partly current and partly non-current in nature? Okay, I think I may not get an answer for this as well. I think we started on a very technical note. No answer since morning. Oh my God. So I think it's going to be definitely split between current and non-current, because there is a portion which is payable within the next 1 year as well. And my advice is, since the requirement of the question is asking to show the relevant extracts of the balance sheet, it'll be a good idea that if you want to show the current and non-current portion, you should make one extra ledger, 1 year extra ledger, because whatever is the next year balance CD, that is supposed to be non-current in nature. So I think let's do one thing. Let's make one extra ledger as well. So let me show you the proper split in terms of the current and the non-current. Now, since in this particular case, you want the information for the balance sheet presentation, as I said, a very crucial point, it is a good idea that you make your ledger account for 1 year extra. As I said, it is a good idea to make 1 year extra ledger. So this becomes the opening balance 11,000,62. We take the finance income at the rate of 10%, 1,006. And then we get the collections. The principal amount is 3 lakh. And I think the interest, if I rightly remember, is 72. And we get the balance CD as a balancing figure. So 11,000,62 plus 11,006 minus 372. This is 838,068. Now I think let me put my point across very carefully. As I said, when you're going to present this in the balance sheet, it is not purely non-current in nature. So what we can do in this stage, this is the amount which is non-current in nature. And the difference between the two, this is something which is going to be current asset in nature. Because that once the loan account is presented in the balance sheet, something is recoverable within a period of 1 year, and that is current in nature. So this balance at the end of first year and this balance at the end of second year, this is going to be recoverable within a period of 1 year. That's going to be reflected as a current asset in the balance sheet. And this portion is supposed to be non-current. So the moral of the story, which I want to, again stress upon is that it's a good idea to make 1 year extra leisure. Because if you want to split the presentation between current and non-current, it is always better you make one extra leisure. You'll easily get the split. Okay, so this is done. Now we go for the annual amortization. So we take 1/5 of this, 145,398 by 5. So this is going to be approximately 29080, and we get the balance CD as a balancing figure. So 145,398 minus 29080, this is 116,318. That becomes a balance CD. Now, the next question also rises, that is this balance also going to be reflected as non-current or current plus non-current both? Again, it is going to be current and non-current. And here, you don't need to make an extra leisure because the annual amortization figure is common every year. So in this particular case, when you go to show the split in the balance sheet, you can easily show the split like this. That out of this, you've got a current and a non-current portion. 29080 is going to be amortized in the next year. That becomes current in nature. And the rest 116,318 minus 29080, 87,238, that becomes non-current in nature. So with this ledger accounts, we've also been able to organize the elements for balance sheet presentation, what is current and non-current. I think let's also have a focus in terms of the P&L, what goes in the P&L. So I think if we just organize the data in terms of the profit and loss as well, I would say in the P&L, there is going to be a credit of finance income. That's one, which is 135,460. And the second is there is going to be a debit on account of the prepaid staff cost, the annual amortization, which is 29080. So this gives us the element of, you can say, other expense. Now, if you look at the requirement carefully, it says you are required to explain how the housing loans would appear. And it said before the requirement that you need to show what is the correct treatment of the loan done, interest and the other expense. So this is the interest income and that is the other expense in the P&L. So the good idea would be that when such a question comes to you, you need to give the examiner the journal entries, that's one, and then extract balance sheets and extract P&L as well. Though I did not make the extract balance sheets in P&L, which of course you can present with the data available to you, but it's a good idea that you tell the examiner carefully that, okay, this is the current and the non-current portion presented in the balance sheet. So making the journal entries and making extract financial statements is a brilliant idea, because I think the question has got a weightage of 12 marks. So you need to present it absolutely with the extracts. So may we know the question number, page number in the study material as we correlate it effectively. This, I don't know, is in the study material or not, but it's a November 2020 examination question. In fact, I've already uploaded this particular assignment in the previous, LMS as well in the previous class. So you can maybe download the entire assignment. The entire assignment is there in the LMS as well. Okay, so this is done. I guess the rest presentation can be taken care. I think now let's take it further. Let's go to the next one now. So we're going to make some summary mind map later. Let's, in the meantime, now take you further. Another examination question. We're looking at another examination question. That is question number 9. This is December 21, simple and straightforward 5-mark. Simple and straight 5-marker, simple question. Now, let's, I think, again, have a little read on the inputs which are given in this particular case. So I am given the inputs in this case. It says M made a security deposit whose details are given. I think I'd like to go to the requirement first, determine how the above financial asset should be measured and briefly explain the measurement determined as such. Make the necessary entries for accounting of the security deposit in the first year as well as in the last year. Assume that the market rate for a deposit for a similar deposit is 9% per annum. Okay, I think now let's read the inputs in the question. The company M made a security deposit and we are given the starting date is April 16 and the ending date is 21. So it's a deposit of 5 years and the deposit is made in connection with the lease. Here again, we know that the interest rate on this deposit, we are not given any contracted interest rate on this particular deposit, which means it is undoubtedly considered to be zero. So it is again an off-market transaction for sure. Because the contracted rate of interest is zero and the market rate of interest is 9%. So here again, you would notice a difference between a transaction value versus a fair value. Difference will again arise. I think let's take the liberty of asking again. If there is going to be a difference in the transaction value and the fair value, where are you going to take this difference? Remember, this is a case of a lease transaction. It is a case of a transaction between a lessor and a lessee, that is Ind AS 116. So this is the amount of deposit and that is the discounting factors. Again, reading the requirements quickly. How the financial asset is measured and briefly explain the measurement as such. Okay, so my question still remains. You need to tell me how are you going to account for the difference between the transaction value and a fair value arising out of this security deposit for a lease transaction. I am still waiting for your inputs on that. I think I'll have to probably answer this question at the very start itself. It seems, we've started a bit technical area indeed. Yes, it is, because this is one of the very important focus areas. I've seen, a couple of questions in the exams which are asked on this area where the examiner is interested to know that do you know how to account for the difference between a transaction value and a fair value at the initial recognition? So let's answer that question right away. In this particular case, it is supposed to be a lease transaction. And if it is a lease transaction, this difference will get adjusted in the right of use asset. Because when you're going to record the security deposit, which is a financial asset, it would be captured at a fair value. And the difference in the fair value and the transaction value is going to be adjusted in the right of use asset. And since you enter into a lease transaction, the right of use asset is as it is recorded. So this amount will get merged with that ROU asset and that ROU asset will get depreciated over the period of the lease. In this particular case, considering that it might be a straight line depreciation, we can simply amortize the ROU asset again on a straight line on the presumption that the depreciations is taken on a straight line on this lease. Okay, let's, I think, take this further. So question number 9, let's first organize the data. And again, I think I'll just like to highlight one important inputs again at this particular stage. And that is, whenever you're looking at a question which involves the accounting of either a financial asset or a financial liability, I think your first focus point should always be to calculate the fair value. Because initial recognitions of all financial assets liability, with limited exceptions, they're all recorded at a fair value. So your first key focus point should always be to organize the fair value calculations. And then typically you'll notice this in terms of financial assets, that if the fair value and the transaction value differs, you need to see where the difference is going to be captured. We've seen two situations so far. One is the employer-employee relationship resulting in a prepaid staff cost. The other one is the lessor-lessee relationship, which is going to lead to an right of use asset. Can there be any other parameters as well? Yes, we'll come to a third relationship very soon after this particular question, which is on the holding and subsidiary relationship. When there is a transaction between the parent and the subsidiary, how do you tackle that? And that's been one of the most important areas in the exam. There's been a couple of questions, where there have been transactions given between the parent and the subsidiary resulting in a difference. How we tackle the difference in the books of both the parties is going to be important. In these two questions, we're looking at the accounting only from the point of view of the holder. That is a financial asset. But when it comes to the parent subsidiary, we need to be very clear on terms of both the aspects. How would the parent account? How would the subsidiary account? But that's going to be next area. So let's come back first of all on the calculation of the fair value. Now, in this particular case, I guess if I calculate the fair value, we are not getting anything except the principal amount. There is no interest contracted. So the only inflow is in terms of the principal amount. So we'll simply consider the present value of the principal amount because that's the only inflow. That's the only inflow which needs to be captured in this particular case. So let's see what is the information given. So I am given the deposit is 20 lakhs. We're given the deposit is supposed to be 20 lakhs. And I'm also given the discounting factor 0.6499. So this will give me the amount of, you can say, present value of the only inflows which are there. So 0.6499 into 20 lakhs, this comes to 12,99,800. There is no other collections, no interest received. The only inflow is the collections of the principal at the end of 5 years. So let's see what is the entry which will be done at the initial stage. The security deposit becomes a financial asset. In the brackets, I'll write down financial asset that gets a debit. And in this particular case, this is going to be, we are receiving the deposit. We're looking at the transaction from the point of view of the lessee. And the bank gets a credit. So this is, of course, the transaction value, and this is the fair value. And I've already made it very clear that this difference, because of the lessor-lessee relationship, is going to be taken as right of use asset. So this is going to be minus 20 lakhs. It comes to 7,200,000 is the right of use asset. So I think let me just make it clear that in this case, there is a lessor and a lessee relationship. So we're going to make a mind map later in which we will, simply consider what kind of relationships and what kind of accounting treatment applies for the difference in the transaction value and the fair value. So in this particular case, a lessor-lessee relationship, this difference will be adjusted in the right of use asset, and this will be depreciated. And this will be depreciated over the lease term. This is going to be depreciated over the period of lease term. I'm not given what is the depreciation rates, etc. But if you assume a straight line, this is going to be divided by 5 years and spread over equally straight line depreciation, but that would be a presumption. Okay. So this is one thing. I think the question was asking us to reflect the entries initially as well as the end. And let me also tell you that this question also came later as well. I think in one of the questions, it came in November 19 exam as well. So it came twice in the exams, November 19 and this one. So it's come like twice in the exam, but it came for like 4 marks earlier and it came for 5 marks. So this is, pretty simple, 4-5 marker only. You want me to make this security deposit ledger, or can I skip that bit, I guess? I think if that's manageable, I think I'll leave that part, because accounting for security deposit is going to be exactly on the same lines as you do a normal financial asset account. In this case, there are no collections as well. You'll keep unwinding the interest, that's it. So can I skip that part? You want me to make the security deposit ledger as well? I think it should be manageable, right? Okay. In the absence, I assume to be a yes. Nobody's saying a yes or no. I'm getting a little feeling, that this all is getting a little, new area to many of you. I think you've not revised this portions well, I guess. Because I think since I started in the morning discussing the transaction value, fair value, it seems to be a little, different area where I think the focus has been a bit less. But we all covered this in detail in the regular sessions as well. concentrating in terms of kind of relationships, and that leads to a difference between the transaction value, fair value, how they are accounted. Basically, three main categories. No worries, we'll make some mind maps after the end of the third area of discussions. Let's go to the next question with you, which is one of the very popular questions in the exam as well. Okay, so let me share this inputs. Let's go to the question number 10. Now, this is a May 18 examination question. It came for 8 marks in the exam. And I think, if I rightly remember, this kind of question, I think, has come earlier in other exams. And I think it's there in the study material also, I guess. Let's, I think, have a read. So I think first thing, what I'm going to do, as usual, read the requirement of the question. I always tell people the best good idea is always that, you should first read the requirement. It gives you a good idea what to do, because the focus would then be based on the requirement, what is to be done. Analyze the given situations, applying the guidance in 109, account for this in the books of H Limited. He's asking us the accounting in the books of H. H here is going to be the holding company, to tell you in advance. It says S issued redeemable preference shares to the holding company H. So S becomes the issuer and H becomes the holder. So the parent company is holding the investments in preference share. And then we're given that these are non-cumulative redeemable preference shares. The period of redemption is 3 years, starting on April 15, ending on March 18. Then I am given the total period, the value of the preference shares, the interest rate, the dividend rate is practically negligible. So you can say the contracted rate of dividend is practically 0. Then it says the market rate of interest is at the rate of 12% and the discounting factor is given. Quite a similar information as compared to the security deposit in the previous question. I think now let's ask you a question. I am a little confident that I'm going to get some answers now. This is a transaction between the parent and subsidiary. So we've seen 3 relationships so far. Number 1, we saw the relationship of employer-employee, resulting in a concession loan, which was a prepaid staff cost amortized annually over the period of the loan. The second one which we saw was a case of a relationship between a lessor and a lessee. And that also gives rise to a difference, which is right of use asset. The third relationship what we're looking at is a parent and a subsidiary. So would you like to tell me, in this case, the difference in transaction value and a fair value is going to be taken as what in the books of the parent company? Any inputs on your side on that? Where are you going to consider the difference between the transaction value and the fair value in this particular case? Let's get your answers. In the meantime, I start my inputs. Any input, friends, on that? Where are you going to account for the difference between the transaction value, fair value? It's a parent-subsidiary relationship. And depending upon that relationship, the difference is get captured in a particular account. No answer so far again. I think I'll have to answer that as well. My God, today it's my questions, my answers only. Are we revising? Okay, so let's, I think, take it further. Question number 10. As I said, there are 2 focus points whenever you start that question. First is organizing the fair value. Second is organizing the difference between the fair value and the transaction value. Where is it going to be captured? And what is going to be the subsidiary accounting for the difference? So in this particular case, let's, I think, begin with the calculation of the fair value. Now here again, in this particular case, we can clearly see that there is no collections by the parent company over the entire period of 3 years. The only collection is the principal amount of that investment. That's it. So the fair value in this case is going to be the present value of the principal amount which is invested. There is no collection of interest interim for the period of 3 years. So in this particular case, we are given the value of the preference shares is, I think, 500 lakhs. And we take the present value. The discounting factor is given 0.5 0.118, sorry, 0.1118 is the present value factor. So this is going to give you the fair value. So this works out at 55.9 lakhs. That is the amount of fair value of the loan which is given. Okay, now what we need to do in this particular case, once we have got this particular figure, now we need to recognize the amount in this particular case. I think it's a little misprint. It can't be 0.118. I think it's 0.7118. This is slight misprint. This is not 1118. It is 7118. So this comes to 355.9 lakhs is the fair value. I'm yet to get the answer still on that. Where are you going to take the difference between the transaction value and the fair value?
Deemed equity
That's
investment.
absolutely correct. Wonderful indeed. So let's see the entries which will be done at the recognition of this loan, not loan, rather investment in preference shares. So I think we'll take first of all the investment in preference shares of the subsidiary. And this is going to be debited at the fair value, which is 355.9. This is recorded at the fair value. Then the bank is going to be recorded, of course, at the transaction value, which is 500 lakhs. And the difference, as you rightly said, is going to be a deemed equity investment. So let's call this as a deemed equity investment. And this is the balancing figure in this entry. That comes to 144.1 lakhs. So I think it's again worth making a mention out here, looking at the kind of relationship. So we can make a mention that this deemed equity investment, here it is attributed to parent and subsidiary relationship. And when it comes to a parent-subsidiary relationship, this is considered to be a deemed equity investment because you are making an investment and you're not going to get some amount back, and that money which you're not going to get back is like making an equity investment because you're getting some money back from the preference share. That's a different figure, fair value. The money which you're not going to get back by investment, that becomes indirectly deemed equity investment. That's what is there in the books of the parent. Okay, so this is done, I guess. Now as far as the subsequent accounting is concerned, absolutely in the same line. The question now also arises, what are you going to do with this deemed equity investment for the next 3 years? Nothing. Unlike the right of use asset, which is amortized over the period, unlike the prepaid staff cost, which is amortized over the period, but in this particular case, there will be no subsequent treatment for this deemed equity investment, so it will remain the same. It'll continue to remain the same in the books of accounts. No further accounting will be done. You want me to do the investment in the preference share accounting, or can I skip that again? Or you want me to make a ledger account for a period of 3 years reflecting how the investment in the preference shares will be accounted? Or do you want me to skip that part? Okay, I think I didn't do that in the previous question. Maybe I'll do this in this one. Let's do it. So let's give you the accounting for the investment in the preference shares for the period of 3 years. And in this case, there is no inflows in between. So we've got investment in the preference shares. That becomes a financial asset for the parent. So this is recorded at a fair value. And the fair value is 355.9. So we record the finance income. At what rate are you going to capture the finance income? The market rate of interest was at the rate of 12%. So we do the unwinding at 12%. That's 42.708. No collections, just take the balance CD, balancing figure. That's 398.608. This becomes a balance BD. 398.608. Then again, we take a balance finance income 12%, 47.833. And this will be balance CD again, balancing figure. That comes to 446.441. So this is 446.441. I think in the last year, I'll not take the finance income. I'll just show the collections. We get that money back. I think that was 500 lakhs will be collected. So let's take the finance income as a balancing figure. That's 53.559. And let's see whether this is coming to approximately 12% or not. Yes, it is almost equal to that figure, which means we've done it absolutely correct. So this is how the accounting for the investment in the preference shares will be done for the next 3 years to go. Simple and straight. I think now I'm ready to make a little mind map with you. So I think what we've done is looked into different kind of relationships and how the difference in the, you can say, fair value and the transaction value is accounted for. So I think let's make a quick mind map on this particular part. Let me make a slow little mind map. So I'm looking at now a simple mind map on a discussion so far. And this is on the area when you're looking at a difference between transaction value versus a fair value. We're looking at the difference between a transaction value and a fair value. I'm not saying that the list which I'm giving you is exhaustive in nature, but I think if you look at the questions which are there in the study material, or if you look at the questions which are there in the examination, I feel that there are basically 3 focus areas where we need to consider the difference between the two. One is the case of employer-employee relationship. One is a case of lessor and lessee relationship, and one is the parent and the subsidiary relationship. So what you need to watch out is the kind of relationship, and accordingly you take the difference in the books. So I think we can say we're going to consider a total of 3 kinds of situations. So one is, we can say it is arising on account of employer-employee relationship. One is on account of employer-employee relationship. And you will invariably see this will be pertaining to a concession loan. And I think let's put a small question now at this stage, which I'm sure now I'll get answers. I've already discussed all that. So as far as the concession loan is concerned, where will you take the difference? If it is a case of a concession loan, where are you going to take the difference? It is a concession loan, so you're going to park the difference in which account in this particular case?
Staff cost.
That's right. So we're going to take this in the prepaid staff cost. And what is the accounting treatment of this prepaid staff cost? Is it going to be amortized straight line, right?
Yes, sir.
That's right. It is amortized straight line over the period of loan. So this is what we need to be very crystal clear in our mind, that depending upon the relationship and the situation, you are going to treat this as a prepaid staff cost, which is amortized straight line over the period of the loan. Next. The second one I'm looking at is a lessor-lessee relationship. And if it is a lessor-lessee relationship, I'm looking at a security deposit which is made in the connection. And if there is a security deposit which is made in this connection, let me now ask you, where are you going to take the difference in the books of the lessee? This was accounting in the books of employer. This is accounting in the books of the lessee. So where will you take the difference in transaction and fair value in this particular case? Where will you take the difference pertaining to the security deposit? We just did that. Right of use asset, ROU asset, it will be taken. And this is going to be, you can say, depreciated. This is going to be depreciated over lease term. So this amount is going to be depreciated based over the lease term. And finally, we're looking at the third situation, which is supposed to be the parent-subsidiary relationship. And if it is supposed to be a parent-subsidiary relationship, here I'm looking at the accounting in the books of the parent, and this is, let's say, investment. Let's say investment which is made in the preference shares of the subsidiary. So where are you going to take the difference in this particular case?
Deemed equity.
That's right. It is deemed equity investment. Any accounting treatment to be done as far as this deemed equity investment over the
No.
period?
No, sir.
So there's
No.
going to be no subsequent accounting. So I think this captures our mind map in terms of difference in the transaction value and the fair value. So I think now your mind should be very clear that it all depends upon the kind of relationships and how is the difference accounted in the books of employer, in the books of lessee, and in the books of the parent as well. Okay, now we've got some small little question, but it's an interesting one indeed. Okay, so let's now go further. This is all again a very crucial area which is constantly being tested in the exams. Okay, so let me now come back on the assignment. So question number 10 is done. Now we're looking at question number 11. This is examination question again. And in this particular case, this has also been, a very, very relevant questions in the exam. I think we can just maybe discuss this quickly instead of doing this, unless you want me to do this. I will just, analyze this bit, discuss this bit, and then take it further. It says RAM is a company incorporated in India. It provides 25 lakh interest-free loan to its wholly owned subsidiary, Balram. The parent is given an interest-free loan to its subsidiary and there is no TC. How should the loan be accounted for in the light of the provisions related to Ind AS in the books of Ram, Balram, and consolidation? Wow. Now, the focus is not only the books of the parent, but also the books of the subsidiary and also the consolidated financial statements of the group. So we got three focus points. How the accounting of the loan given by the parent to the subsidiary, which is an interest-free loan, accounted in the books of parent, subsidiary, and the console. There are three situations. The loan is repayable on demand. The loan is repayable after 3 years, and the current market rate for similar loans is 12% for both the parent and the subsidiary, though it's an interest-free loan. Then he says the loan is repayable when Balram has funds to repay the loan. Briefly analyze the above scenarios. Also look at the journal entries in the books of Ram and in the books of Balram in the two scenarios 1 and 2. Then he has also given you the present value factor at the rate of 12%, 12 marks. So you've got 3 parts and there are 3 books. So I think it's wonderful indeed because you just need to show the focus of the entry. I think just have a look at the read once again because I think this time I want your inputs. So just keep the facts very clear in the mind. The parent is given an interest-free loan to the subsidiary. In the first case, we are given the loan is payable on demand. Second, we're given it's a tenure of 3 years. And the third, we're given that the subsidiary is going to repay the loan when the funds are there. When he has got funds, he will make a repayment. Now, you need to make an assessment in the third case whether it's a repayable on demand or not. And then we are required to give the entries in the respective books of accounts. I think let's begin. I'll just quickly make a simple chart in this particular case. Let's get your inputs on that side. So this is question number 11, what we're doing now. Let's, I think, make a simple little summary chart for the accounting. So we are on question number 11. So I want to make a simple little chart covering all the permutations and combinations, at least to understand initially. So we're looking at the books of the parent, we're looking at the books of the subsidiary, and we're looking at the consolidated financial statements as well. The question is very clear and focused that he wants the entries in the books of parent, subsidiary, and the consolidation. So we're looking at the entries in the books of parent, we're looking at the entries in the books of subsidiary, and we're looking at the consolidated financial statements. And there are three situations. One is that it is a loan which is repayable on demand. I think you've already known this. We've spoken it a number of times, but I think let me still again put that sentence to get the vouching done. Can I say if it is a loan which is repayable or recoverable on demand, do you recognize it in the books at fair value or transaction value? We're looking at a loan which is recoverable on demand for the parent and it is repayable on demand for the subsidiary. So are you going to recognize the financial asset liability at a fair value or at a transaction value? At the very start also, I gave you that all financial assets are taken at a fair value except all financial liabilities are taken at fair value except. I think this one also I'll have to answer. That's a bad day today. Nobody is actively giving any answers. Are we revising or am I only telling you things? Let me put the question once again, friends, to you. When it is a case of a loan payable and recoverable on demand, do you capture the financial asset liability at a fair value or at a transaction value? Simple. Okay, I think I'll have to answer that, remind you back again. It's always taken into transaction value. So there are two cases when the financial assets and liabilities are captured at a fair transaction value. In terms of financial asset trade receivable and loan recoverable on demand. In terms of financial liabilities, trades payable and a loan repayable on demand. So in this particular case, when the loan is recoverable and payable on demand, there is going to be no concept of fair value. So let me put it point blank out here. If it is a loan repayable on demand, the fair value concept is not going to be applicable. We're going to capture things at a transaction value itself. So let's have a look at the entry. Can I say the parent will put the entry, loan gets a debit, bank gets a credit, and this will be at the transaction value itself. So what was the transaction value? The loan was for 25 lakhs. So this works out at 25 lakhs done. I think I'm sure I'm not going to get answer for my next question as well, but I still want to ask you that question. Is there going to be any interest entries which will be recorded in this particular case for the tenure of the loan? I think at the first instance, there is no tenure because it is recoverable and payable on demand. But still, do you think we're going to capture any interest in the books of both the parties, the parent and the subsidiary? Of course not. So no entries for interest will also be captured. So he puts the entry, bank gets a debit and loan gets a credit. He also records it at a transaction value itself because it's a loan recoverable payable on demand. And these entries will be reversed at the end of the tenure. You know, whenever the loan is repaid, these entries will be reversed. So I think let me just make a quick mention. So whatever are these entries, we can simply say that these entries, we can say these entries will be reversed on repayment. So whenever the repayment of this particular loan will take place, these entries will be reversed at that particular stage. He gets the money, he reverses the entry, he pays the money, he reverses the entry. And coming to the picture on consolidated financial statements, can I say intercompany owings, it gets cancelled, so there is going to be no impact. So it is, you will cancel intercompany owings. The intercompany transactions will get cancelled, so there will be no impact in the books of the consolidated financial statements. So that is point number one. Second, there are three requirements for the question. Now we're looking at the second one. The first is that if it is recoverable and repayable on demand, we capture transactions at a transaction value, no concern with fair value. No subsequent entries for interest will also be captured in this particular case. The next input which is given, I think if I just like to take you back on the question just to have a look. The second one is very clearly given. The loan is repayable after 3 years and the current rate of interest is at the rate of 12%. Now, if the loan is supposed to be repayable after a period of 3 years, then it is no longer repayable on demand. So what we're going to do in this particular case, the tenure of the loan is 3 years. The tenure of the loan is 3 years. So now the question rises, would the concept of the fair value apply in this particular case? Yes, of course. It is not a case of loan repayable on demand. So we can say in this particular case, the fair value concept would apply. So what we're going to do in this case, the loan gets a debit at a fair value. The bank gets a credit. That is the transaction value. So this is 25 lakhs. And I think we need to get the fair value of this loan. The fair value of this loan, it's an interest-free loan. So you just going to get the principal amount at the end of 3 years. So do the discounting of that principal amount. I think I'll give you the figures. The discounting, I think, is at 12%. So let's see the discounting at 12%, 0.8929. Sorry, for 3 years, 12% discounting would mean 0.7118 into 25 lakhs. This comes to 17 lakh 79,500. And would you like to tell me where are you going to take the difference? So would you like to tell me that in this particular case, where are you going to take the difference in this case? I think we've already done this. So where are you going to take the difference in this particular case? Can I say this is going to be deemed equity investments again? So this is deemed equity investments. Let's see the balancing figure. This comes to 720,500. Now, will there be a capturing of interest which will be recorded for the next 3 years? Of course, yes. So you would be unwinding the interest income in the books of the parent for the next 3 years, and that would be a normal accounting. Similarly, he would also pass an entry that is bank gets a debit, and that is to the extent of 25 lakhs. The loan which is taken gets a credit at the fair value 1779,500. And would you like to tell me where are you going to take the difference on the credit side? And that's a crucial point. Where are you going to take the difference in the books of the subsidiary?
Same, deemed equity investment.
No, not deemed equity investment in this case. So in this particular case, where are you going to consider this amount? This is going to be what? Equity contribution, not investment. So this becomes an equity contribution in this particular case. So the amount is same, 720,500. And can I say for the consolidation point of view, it'll get cancelled as an intercompany owing. So there is going to be no effect in the books of accounts again. By the way, a small little question further comes to my mind, which I think I'd like to discuss immediately at this stage. In this case, it's a loan which is taken by the subsidiary. The parent is given a loan, so subsidiary has, taken a loan. But it can be vice versa as well. Let's say if the subsidiary gives a loan, then what entry? I'll come to that particular part. We'll make a little small chart maybe after this end. Now let's go to the third part. So let me again share the question back on the screen for the third part. Now, in the third part, what you need to make an assessment is, it says the loan is repayable when Balram will get money to repay. Does this mean that the loan is repayable, recoverable on demand? No. Because in this case, when the subsidy says, I'll repay the money as and when I get the money, that means it's not repayable on demand. So is the accounting treatment for the point number 3 exactly same as point number 2? Are you going to consider this something similar to the point number 2 because it's not a loan repayable, recoverable on demand? Is my thoughts correct? Is the third one going to be the same as the second part? Of course, yes. The accounting entries would remain the same. So this gives us the inputs in terms of how the accounting between the parent and subsidiary takes place. Now, coming back to the question which I asked you, I think that's important to see. I was looking at this particular part where the subsidiary is recording on the credit side equity contribution. If it is a reverse entry, so what would he record on the debit side? If it is a reverse entry, what do you think he's going to record on the debit side? Can I say this is going to be dividend payable? It's going to be a dividend payable because if the subsidiary gets a difference on the debit side of its entry, it's going to be like, he's paid a dividends to the parent company. That's the point which I wanted to make. So you can see that if the difference is on the credit side, it is equity contribution. Not equity contribution in the sense it creates an equity in the books of accounts. I'll not use the word contribution. That can be slightly confusing. But in this particular case, if the difference comes on the debit side, it's going to be dividend payable. You can put that amount in the retained earnings. It's like a dividend which is paid by the subsidiary to the parent company. Okay, so I think this takes care of one another important area. Our focus was on transaction value versus fair value differences depending upon the different kind of relationship. So that focus area is done. Now let's go to the next area with you. Now this is a brilliant question coming in. I think it's come in the exams also once or twice. It's there in the study material also. It's a brilliant question. It blends the concept of two major concepts. One is the transaction value and the fair value, and one is the concept of prepayments. That there has been a prepayment in terms of loans. How do you tackle that? Good question indeed. Let's read the next question with you, which is going to take time, but it's a very good question indeed. Okay, so let me, I guess, take it further. Let me share the next question to you. Question number 12. Wow, this is a good question indeed. It is January 21. It came for 14 marks in the exam. Also was there in MTP in October 22. Let's read the requirement of the question. Let's first read the requirement of the question, then I think we'll read the inputs. So this is going to take some time to do because this is a bigger question. A lot of calculations are required to be done in this particular question. You're required to pass journal entries in the books of Lovely considering the requirements of 109. So nothing too technical asked in the requirement. We'll have to now go through the inputs in this case. Now let's read the inputs in this particular case. It says Lovely has a policy of providing a subsidized loan to its employees. I think the moment I read that it is a subsidized or a concession loan, what immediately floats to my mind is a concession loan. And that comes to the mind is employer-employee relationship, and that will lead to a prepaid staff cost. It says for the purpose of buying two-wheelers and four-wheeler vehicles, Simran, who is a sales executive, took a loan for a four-wheeler vehicle and the terms of the loan is given. The principal amount of the loan is given. The interest is at the rate of 5% on the first 3 lakhs and then it is 8% for the remaining amount. So interest is not charged at a flat rate, but it is being charged on a slab system. We're taking on the first 3 lakh 5%, and then on the remaining, you can say 6 lakhs, it is at the rate of 8%. The loan is disbursed on 1st April 17 with a tenure of 3 years, and there is a prepayment either in full or partial at the option of the employee. Simran shall remain in service till the end of the loan ends. The principal amount, the very clearly word says the principal amount should be recovered in 3 equal installments at the end of each year and will be first applied towards 8% bearing principal. So when you're going to repay the money, it says assume that the repayment is first done towards the portion where the interest rate is more. Then he says the accrued interest is paid on annual basis. The market rate of interest is 12%. So in any case, the interest rate contracted is 5 and 8 and the market rate is 12. Undoubtedly, it is an off-market transaction. And if it is an off-market transaction, I think all the inputs which we discussed would flow. Now it says following table shows the expected contractual cash flows. So we are given that there is an outflow at time 0. Then the principal is being collected in 3 equal installments. He's already given you the interest calculations as well. So we can see that the interest is at the rate of 8% and 5% respectively. On that 3 lakhs, there is a 5% interest, makes it 15. And on the 6 lakh, you've got interest, which is 48. Then 3 lakh is paid. So we're taking the interest accordingly. So this is what the contractual cash flows were expected. But he says Simran prepays a loan of 1 lakh rupees on March 19. So the loan was taken on March 17, and you can say 2 years later. 2 years later, after the loan, there has been a prepayment of 1 lakh. And the following table shows the actual cash flows. Previously, it was expected cash flow. Now he's giving you information about the actual cash flows, considering the prepayment on 31st March 19. Okay, then I am given that this is the total loan which is given. The principal repayment was 3 lakhs. And then, in the end of second year, there's another extra 1 lakh paid. So later there is only 2 lakhs paid. Accordingly, the interest calculations have undergone a change out here. And this is how the principal outstanding amounts are given. So this is the expected and the actual cash flows given. So very simple and straight data. We're given the inputs with regard to the contractual cash flows. We're given the inputs with regard to the actual cash flows after the repayments are done. And you're required to give the entries in the books of Lovely based on the requirements of Ind AS 109. So January 21, 14 marks examination question. So I want your active participation, friends, on this particular question. It's going to involve a lot of calculations indeed. So I think let's first organize the data. In any case, we have seen one thing very clear. It's an off-market transaction. It is a case of concession loan. So I think in the first instance, you need to organize the fair value, get the difference between the fair value and the transaction value, which is going to be attributed to the prepaid staff cost. But that's just the beginning. Now, once the prepayment of the loan takes place and the employee makes a prepayment of 1 lakh rupee, you need to attribute that 1 lakh, how much is paid towards the principal or loan amount and what is adjusted against the prepaid staff cost. I think that's the crucial part of the solution. So let's begin. So this is question number 12. Let's start organizing the data. So question number 12. So I think the first focus in this particular case, of course, as usual, is to calculate the fair value of this particular loan before we proceed further. Okay, so let's, I think, organize the fair value to begin with. So we've got year and we've got principal and we've got the interest collections. We can consider the total cash inflows, do the discounting and get the present value. So we just organize the information so we can get the present value of all the future inflows pertaining to this loan. So I think this is a total tenure of 3 years. And let me, I think, ask you a very obvious question, at least to begin with. Now, when you're considering the calculation of the fair value, are you going to consider the calculation of the fair value based on the expected contractual cash flows chart given in the question? Can I directly take that simple chart and consider the calculation of the fair value? Yes or no? You're already given the contractual cash flows. So can I take that contractual cash flows, the principal, interest, everything is well organized. Can I directly take that for the fair value calculations? And that's rightly said, yes. So let me just copy the information. So we've got 3 lakhs. We've got 3 lakhs out here. And as far as the interest is concerned, 48 plus 15, that's 63. Then it is 24 per 15, that's 39. And this is 15. So I don't need to calculate anything. The question has very clearly given you the principals and the interest calculations. So this comes to 363. This is 339 and this is 3,15,000. And then we can take the PVIF as well. So in terms of the discounting rate, we are given it's at the rate of 12%. I think I'll just simply give you the fair value to save time. So you can keep getting the present value factors at 12%, keep doing the discounting. So this, I think, works out at 818,622. 818,622. That becomes the fair value of this loan. So I think with this particular chart now, we can simply organize the entry at day one when the loan is given, which is supposed to be on 1st April 17. So let me just organize the entry as well, or maybe we can just do it on the next slide. So on 1st April 17, the employer will put the entry loan that is financial asset gets a debit at the fair value. That is 818,622. And the bank gets recorded with the fair value, sorry, the transaction value, which is, I guess, 9 lakhs. And we very clearly know that this difference is going to be a prepaid staff cost. And you can, of course, give the inputs to the examiner. You need to give your explanation as well. How did you reach a conclusion that this is a prepaid staff cost? Tell the examiner it's an employer-employee relationship and the difference is attributed as prepaid staff cost. So let's see what is the balance. 9 lakhs minus 818,622. This is 81,378. And I think I'll just make a quick mention on this, that this is supposed to be based on employer-employee relationship. This is based on the employer-employee relationship, and therefore it is treated as a prepaid staff cost in this case. Okay, now, once you've identified the difference that this is a prepaid staff cost, and we also know that this prepaid staff cost is going to be amortized straight line, it is going to be amortized straight line over a period of next 3 years in this case, originally. Now the focus is to make a ledger account for the loan. And now the focus is also to make the prepaid staff cost. So I think let's make a ledger account, though you can make an amortization chart as well. But I always prefer to make ledger. It gets more easy and more convenient in nature. So let's, I think, make the ledger account for the next 2 years to go. So let's make the financial asset loan account. And let's make the prepaid staff cost as well. So this is the loan that is financial asset. And this is the prepaid staff cost. So before the repayment happens, I need to consider the accounting before the repayment happens. In this case, make your ledger account absolutely in a usual manner before the repayment occurs. Then the crucial treatment with reference to the repayment will be taken care at that stage. So let's begin with 1st April 17. So we record the financial asset at a fair value, that is 818,622. That's 818,622. So first we're going to capture the finance income in the books of accounts. And this is going to be at the end of the year. I think the interest rate is 12%. 818,622 at the rate of 12%. I think it's 98,235. 98,235 rounded off to the nearest decimal. And then we receive the collections. There are 2 collections, I guess. One is the principal and one is the interest, which I can directly take from this chart itself. 363 is the collection in the first year, the principal with the interest. And we can get the balance CD as a balancing figure. The first year ledger gets done. So 818,622, 98,235 minus 363. This is 553,857. So this is 553,857. That becomes the balance BD. Okay, now this is the year when the repayment is done, but I think let's first calculate the finance income as usual at 12% unwinding. So we take a 12% interest on this. That is 66,463. This is 66,463. That becomes the interest. And then let's also get the collections from the original chart. So I can take the figure of 3,39,000. That is the collections, principal, and the interest. Now the crucial journey begins, because now we know that in this particular case, 1 lakh is collected as a prepayment. And I think now we need to consider that 1 lakh which is collected on a prepayment, how do you split that 1 lakh rupee between the component adjusted towards the loan and what is adjusted towards the staff cost? Let's get this information from your side. In the meantime, let me also do the amortization. So let me also consider the amortization of the prepaid staff cost. This is 81,378. So let's take 1/3 amortization. So let's make the ledger account also for the second year end. So we consider 81,378, 1/3 would mean 27,126. We get the balance CD, balancing figure. That's 54,252. That is 54,252. And again, consider the annual amortization in this case as well. So I guess if I take the amortization in this case, it is 27,126. Okay, so I think we reached the point. This is the point at which a repayment occurs. We are standing on the year when 1 lakh rupees repayment is done by the employee. Now, would you like to give me some inputs? How are you going to treat that 1 lakh? How will you split that 1 lakh between the two ledger accounts? Any inputs on that? So let's get the information from your side. What do you say? What am I supposed to do now? How would I decide that 1 lakh rupees principal repayment that is supposed to be adjusted and bifurcated between the two? The loan account, how much gets adjusted in the loan, how much gets adjusted in the prepaid staff cost? Any insights? I think I'll have to do the honors as well. Today seems to be technical questions coming in. So what do you need to do in this particular case now? You need to consider whatever is the remaining cash flows. You need to discount the remaining cash flows and consider what will be the fair value of this loan. So let's do one thing. Let's do an exercise. We need to now consider the present value of remaining cash flows. We need to consider the present value of the remaining cash flows to get the fair value of this loan. So let's consider what is the principal and the interest. And I guess in this particular case, what you can do, the remaining cash flows is based on the second chart which is given in the question. I think let me share that on the screen as well. So we are given a second chart, and I think that second chart is going to be helpful. So I am given the year 2020, you're going to get 2 lakhs of principal and you're going to get that 10,000 interest. So the inflows at the end of third year is going to be 2 lakhs plus 10,000. That's the only portion which needs to be discounted. So let's take the present value of the remaining cash flow. So we can say this is going to be 2 lakh 10. The principal amount plus the interest which is now expected to be collected. And we just need a PVIF. This is at the rate of 12% first year end, because now we are standing 1 year away. We're standing at 1 year away. So let's just do the discounting for 1 year. That comes to 0.898929. So 0.8929 if we take it till 4 decimal places. Or let's take it to the 3 decimals, 0.893. Because we'll get exact figure. So this is coming to 187,530. This is the present value based on the remaining cash flows in the books of accounts. Okay. Now, what we need to do in this particular case is a simple exercise. you have the book value of the loan and you have the amount which is to be, which is the present value of the remaining cash flows. The difference is what needs to be adjusted in the ledger. So let's do one thing. Let's pick up now what is the book value of the loan, so we can compare the two. So we need what is the balance at this stage. We need the balance at this stage. 553, 857, 66463, 339. The balance at this stage is 281, 320. So we need to get the balance in the ledger account at this stage, 281, 320. So in this particular case, now this difference is the amount to be adjusted towards the loan. Basically, what you need to do at the time of repayment is, what is the book value of the financial asset, the present value of the remaining cash flows. So you need to bring the loan at the present value of the cash flows. So difference is going to be adjusted. That will give you the split of that 1 lakh. So this comes to 93,790. So we can say out of that 1 lakh rupees of prepayment made by the employee, this amount gets adjusted towards, you can say, the loan, and the rest will get adjusted against the prepaid staff cost. So 93,790. So we record this amount 93,790, and we also record this amount bank. So out of 1 lakh rupees of repayment, 93,790 gets adjusted against the loan. So whatever is the remaining portion will get adjusted against the prepaid staff cost as well. So this works out at 6210. I think now the position is very clear. We can even go and make a ledger account for the next year as well. Let's get the balance CD as a balancing figure. So this is going to be 281,320 minus 93,790. That we have already worked out, 187,530. That becomes the balance BD next year, 187,530. I think let me also make a ledger account for the next year as well, just for a conceptual clarity, I guess. So we can take the finance income as a balancing figure, but we know that the money which is going to be collected is 2,10,000 in the next year, because now the chart which is already given in the question gives you the status that 2 lakhs principal and 10,000 interest is going to be collected. So let's take the finance income as a balancing figure on a safe side. That's 22,470, and you can just make a check whether this is coming to 12% or not. And yes, it is approximately coming to 12%, which means the ledger account for the financial asset is done. Now let's also make the ledger account for this year. Let's take the balance CD as a balancing figure, and then we can make the ledger account. Third year, the entire amount will be written off. So 27,126, 6210. This is 20,916. That becomes the balance BD in the next year. And then this can be written off in the next year, 21,20,916. Great. So this was the movements in terms of the ledger accounts when you're looking at a prepayment of a loan. So you can see there are two blends in this question. One is with reference to the difference in the transaction value and a fair value. And then on the prepayment of the loan, you can see that amount is getting adjusted against the loan and the prepaid staff cost. So the other crucial point was deciding that once the prepayment is done by the employee, out of that prepayment amount, how do you adjust the difference? You need to compare the book value of the loan versus the present value of the remaining cash flows. So some portion gets adjusted towards the loan amount and the remaining portion gets adjusted against the prepaid staff cost as well. Wonderful. So I think this takes care of the inputs with reference to the financial assets accounting in detail. We yet to discuss now the financial liability accounting. We did the chart, but we did not do a question on that area. But I've done now complete accounting of financial assets. Your mind should be very clear in terms of financial asset accounting for all debt investments, equity investments carried at different values, and also the difference in transaction value and fair value differences, and the special issue which is a prepayment of the loan. Let's now go to the next one. So let's now go to the next question with you. Now we're looking at question number 13, which is on a pure financial liability. So this is a question concentrated only on the financial liability calculation. So let me first read the requirement of the question. It's a small little question, May 22 examination question, and it came for just 5 marks in the exam. A similar kind of question is there in the study material as well, but I think in the study, the effective interest rate, I think, is not given, unlike in this particular case. It says compute the interest to be charged in the statement of P&L every quarter over the period of the loan, and the effective interest rate is already given per annum. So I think maybe we can make a ledger account just for a period of 1 year instead of making the ledger account for all the years put together. Now let's, I think, go back on the requirements, the dates. It says X made a borrowing from RGD Bank for 20,000 at a fixed rate of 12% per annum. There is a loan processing fees which is paid additionally amounting to 1,000. I can't stop myself from asking a question now. What is going to be the accounting treatment of this processing fee? Because you need to be clear on the accounting treatment in terms of TC. You need to be clear in terms of accounting treatment for the processing fee. So when the banker is going to charge you a processing fee of 1,000, what are you going to do with this amount? For the bank, it becomes an advance, but for the X Limited, it becomes a financial liability. We are looking at the accounting in the books of X Limited, by the way. So do let me know what will be the accounting treatment of this processing fee in the books of X. And the loan is repayable in 4 half-yearly installments of 5,000 each. The loan amount is given, and the starting loan is 2020, and the period of the loan is supposed to be 4 years, 2021, then 22. Sorry, it's paid in 2 years. The loan period is 2 years, but it's payable in 4 equal installments, half-yearly installments of 5,000 each. Then he says the repayment starts on 30th September, and it is paid on half-yearly basis. The interest is 12%, but that is paid quarterly. Now, there are 2 interesting inputs to be seen. One is that the loan is being repaid, it says in half-yearly installments. But as far as the interest is paid, it is on a quarterly basis. So the interest movements are 4 times a year. But the principal movements is supposed to be twice in a year. So we need to be very careful in terms of accounting. By the way, I'm still waiting for inputs in terms of how do you tackle the processing fees in this particular case in the books of X Limited, because we are required to do the entries in the books of X. So any inputs, what are you going to do in the books of X Limited for the processing fees charged? No inputs on that again. Oh my God. Since morning, I think I'm doing so many technical questions. Indeed, I am answering all the questions. I wanted some more active participation. I think this seems to be a little weak area for most of you. Okay, so let's, I think, do this. So processing fees, I think, let me answer that at the very start itself. The processing fee is a reduction from the amount of financial liability. When you're going to recognize the financial liability at the initial stage, you are going to make a reduction at the initial recognition. Okay, so let me organize the data. Yes, I think I got the answer now. That is pretty correct. So the money 20,000 and the processing fees is 1,000. So let's organize the input. I think I'll make the ledger account for a period of 1 year. You can make the ledger accounts on a similar lines for the next year. It's a 2 years loan, but the principal is paid in 4 equal installments, 6 monthly, but the interest is being taken quarterly. So let's consider the financial liability for 1 year. So this is a loan. So first of all, let's record. I think I'll have to take a mention of the dates as well. So it's starting on 1st April, I guess, 2020. So on 1st April 2020, so we first raise the loan. The loan is to the extent of 20,000. and the processing fee is supposed to be 1,000. So we reduce the processing fee, the loan gets captured to the extent of 19. Okay, now what do we need to do in this particular case? We need to be careful that the interest computations are taking place on a quarterly basis. I think let me just share the data once again, so we are totally connected with this. So we can see that the inputs are given. The repayment of the loan starts, it says half yearly basis on 30th September, but the interest is charged as well as paid on a quarterly basis, which is at the effective rate 16.6 is the EIR. So let's, I think, begin. So let's, I think, take the calculations on the first quarter, 30th June. So we need to first of all make the finance charge calculations. Let's see the finance charge calculations. Now, the finance charge is on the EIR. So let's carefully do this. So 19,000 into 16.6% for a period of 3 months quarterly. So 19,000, 16.6, that comes to 789 approximately. And we paid this interest at the end of this quarter. So in this particular case, on 30th June, we paid the money, so interest is paid, but we did not pay 789. We are going to pay the interest at the rate of 12% on the principal loan. So very careful with the calculations. The principal loan is 20,000 and we take interest at the rate of 12% for a quarter. So this is 20,000, 12%, 3 months, that is 600. This is the calculations for the first quarter only. So this is only for the first quarter. The interest is accrued at the rate of EIR for a quarter and the interest is paid on the principal value of the loan. You cannot close the ledger at this stage. Let's go to the next quarter, that is 30th September. We again need to consider the finance charge. And can I say the finance charge will be taken on the outstanding balance at this stage? So you can take the outstanding balance at this stage and the interest will be on that outstanding balance. 19,789 minus 600, this is 19,189, 16.6% for a period of 3 months. At every stage, start calculating what is the outstanding loan and take the effective interest rate on that. This is approximately 796. And then we make a payment on 30th September. This time we need to be careful because we're going to make a principal repayment as well. So 5,000 is the principal repayment and the interest is paid. So we're going to pay 5,000 principal and 600 interest because no portion was paid so far. Okay. Now we go to the next quarter, that is 31st December 2020. Again, we need to consider the finance charge. So again, when you go to consider the finance charge, we're again going to consider the outstanding balance at this stage. So let's, I think, take the outstanding balance at this stage and then calculate the finance charge. So 19,789, 796, and this comes to 14,385. We again take interest at 16.6% for a quarter, that is 3 months. That comes to approximately 597. And again, we make a payment on 31st December. The interest is paid quarterly. But now you need to remember the interest is not going to be 600 because 1/4 repayment of the principal is done. So reduce 600 by 1/4, it comes to 450. Then again, we come back on the information on 31st March 21. And again, we need to consider finance charge. This time again on the outstanding balance again. So I think we just need to take the entire balance now at this stage. So let's see what is the outstanding balance. 19,789, 796, 597. 650, 600 and 450. This is 14,532 at the rate of 16.6% for a period of 3 months again. I hope the balances are correct. I'll just quickly ensure it is right. Yes, so 14,532, 16.6, and this is around 605. And then on 31st of March, we made a payment, 5,000 for the principal and the interest of 450. Finally, you are in a position to take the balance CD as a balancing figure. This is just 1 year. You got to make another 1 year as well. I think this was a little too much for 5 marks in the exam. So you need to do this one more leisure year. But I'm just doing 1 year. You need to doing the leisure account for the second year on the same lines. So 19, 789, 796, 597, 605. This is, I think, 9687. That is the balance CD. Okay, so this is how the financial liability is being prepared, and this ledger account is being prepared on AC, that is amortized cost approach. So accounting for financial liability is also done. Well, so I think our accounting of financial assets, financial liability with special agendas is taken care. Now the focus is going to be on the remaining focus special issues. That is on there, though there is one more area, which is there, and that is the accounting of financial guarantees as well, which I think we'll discuss. But I think before that, I think let's take a break. Your mind must be tired as well. So hope to get some more answers post the break after you. So I think this is one area done. Now we've got issues like, impairment, hedge accounting, and all those things. So we'll spend time on the special issues after the break. So let's give you a 10 minutes break and then join back. Haji. Welcome back, friends. I hope you had a relaxation of mind. So I think now coming to the other agendas on 109, after done the accounting for financial assets, liability, and the special issues related to that, let's go to the next area of discussion with you. So let's share the assignment back to you. Now we are looking at the concept of a derecognition. So I'm looking at now the derecognition of financial liability. I think that's another one area, where you get a couple of questions in the exam where you're required to make calculations and identification whether it is supposed to be a case of extinguishment accounting or a case of a modification accounting. So I think let's have a look at the question number 15. I'll just first go to the requirement of the question. So this is a mock test paper, question 2018. Or maybe we can do, I think, another similar question. Maybe we can do question 16. Although let's, I think, do this one only. 16, I can give you as homework to do. That is again similar question, December 21, 12 marks examination question. So I think let's have a look at now the details given. It says on 1st January 2021, A issues a 10-year bond, which is for 10 lakhs, bearing interest at the rate of 10%, which is payable annually on December 31st each year. The bonds are redeemable on December 29. That means a total tenure of 10 years. Because you are starting from January 2020 and it's repayable on December 29. So already given it's a 10-year bond. And then it says no cost or fees is incurred. So no processing fee, no TC, which means the coupon rate and the effective rate is same. That's already given. It's at the rate of 10%. Then he says on January 25, that is 5 years later, ABC and the bondholders agreed to modification in accordance with the term get extended by another 2 years and the interest payments are reduced to 5% per annum. So there has been a renegotiations and due to which the interest rate has decreased from a 10% to 5%. The period of the loan has got extended by another 2 years and the bonds are now redeemable at 15 lakh instead of 10 lakh. And the legal and other fees incurred is also given. A determines that the market rate of interest on January 25 for borrowings on a similar rate is 11%. The repayment schedule for the original debt till the date of renegotiation is given. So we're given that the interest is being paid, which is 1 lakh every year, and that's a repayment schedule. That really doesn't concern me much. We are required to suggest the appropriate accounting treatment. Now, I think as we solve this particular question, the focus point, what comes to the mind is that the main focus is a renegotiation after a period of 5 years. And once a renegotiation takes place after the period of 5 years, you need to basically apply what we call the 10% test. And the 10% test will decide the fate whether we are applying an extinguishment accounting or we are applying a modification accounting. So that all will depend upon the 10% test results. But I think the crucial points which you need to keep in mind is when you're working out the calculations of the 10% test, what figures are taken in the 10% test, that is something which is crucial to understand. So I think let's do one thing. Let's now organize the data. So we are on question number 15. So let's first organize the inputs. So at the first instance, what we need to do, we need to apply a 10% test. Sitting on the 5 years later, we need to see that is it a case of extinguishment or a modification accounting. So I think I'm just going to give that heading as a 10% test. And for this, we need a simple 3 steps to apply. Well, in the first instance, what you need to do, you need to consider the present value of the remaining cash flows considering the original terms itself. In step number 2, you need to consider the present value of the, you can say, renegotiated cash flows based on the new terms. And then you need to see the percentage change which has occurred. So in the first step, we are going to consider the present value of remaining cash flows the present value of remaining cash flows. This is all based on the original terms itself. Now, a quick question to you at this stage. The interest rate, coupon rate is 10%. The effective rate is also 10%. Can I conveniently say at any point of time, the present value of the remaining cash flows will always be equal to 10 lakhs? What do you say? The book value of the loan, and you can say the book value of the loan is going to be equal to the present value of remaining cash flows at any point of time. Is my thought correct? Can I directly consider the present value of the remaining cash flows equal to the principal amount of the loan itself? Any inputs on that? Can I comfortably take the remaining values as directly the same amount itself? Of course we can. So I think 10 lakhs is the amount. Even if you want to compute the same, you can compute it, you get the same results. So if you're going to consider the principal and the interest repayment for the remaining 5 years of tenure, you're going to get the same answer, 100% guarantee. Next, we're going to consider the present value of the new cash flows that is renegotiated based on the modified terms. So we need to consider what is the present value of the remaining cash flows. And the interesting part which you need to keep in mind is when you're doing step number 1 or step number 2, the discounting rate is going to be what? I think let me at least ask you a few questions now. So when you're going to consider the step 1 or the step 2 for the 10% test, what is the discount rate which you are going to consider? Different discount rates or the common discount rate for both the steps? I don't think so. I'm going to get answers today. It seems to be a bad day of asking a lot of questions today. Technical area. So we're going to consider the original EIR itself, and which is at the rate of 10%. Because you need to remember some crucial points that when you conduct a 10% test, your step 1, step 2, what does it consider? What rate of discount does it consider? So you need to keep in mind the step 1 is based on original EIR, original terms, remaining cash flow. The step number 2 is based on original EIR, but that's modified cash flows, but including the TC as well. Remember, in the step number 2, you need to consider all the outflows, including the TC. Okay, now I think let me just consider the data. So I think I'll just put the question in front of me as well. So in this particular case, if I consider the prepayments, the new cash flows, we can say we are going to pay interest at the rate of 5% now. So can I say on 10 lakh rupees, you're going to pay 5% for the next 5 years. So we need a PVIFA, which is at the rate of 10% for the next 5 years. You also need to consider the principal repayment, which is now 15 lakhs. This is we need is a PVIF at the rate of 10%, which is going to be 2 years later. So interest is going to be paid for 7 years now. The tenure is also going to change, because the loan is got extended for another 2 years. So this is going to be a cumulative factor for 7 years. And this is going to be 7th year end when the principal money is repaid. And you also need to include the TC. The transaction cost which is incurred is to the extent of 50,000. We'll take all this into account. So I've taken the interest paid on the new terms for the next 7 years, the principal paid at the end of 7th year, and the TC. Let's get the cumulative factors. So we need a 10%. 1, 2, 3, 4, 5, 6, 7. This is going to be 0.513. This is going to be 4.868. So this is 10 lakh into 5%, 4.868, 243,400. 243,400. I think this comes to a total of 1062,900, I guess. I think this is correct, maybe. So this is coming to a total of this amount. I think the interest I've taken is wrong, I guess. Let me just share the data once again. The interest is at the rate of 5% now on 10 lakhs. That's right. And the principal repayment is now at 15 lakhs. Yes, that is correct. So let's organize the input. Right. So this comes to 1062,900. I think that was 50, or the transaction cost was 1 lakh. Sorry. The transaction cost is not 50,000. This is 1 lakh. So we can get the sum total of this. I hope the calculations are correct. So this is 50,000 into 4.868, 243,400. This is coming to 11,12,900 is the result. I hope the calculations are correct. If somebody can vouch me on that. Okay, now we can see the percentage change. If I look at the percentage change, the difference is 11,12,900 minus 10 lakh. So it is 1,12,900 over the base of 10 lakhs. So if you look at the percentage change, that works out at 11.29%. So once you get 11.29%, the change is more than 10%. So extinguishment accounting or a modification accounting. The variations in terms of cash flows is more than 10%. If it is 10 or more than 10%, then what kind of accounting applies? Extinguishment or a modification accounting? What do you say? You can write down M for a modification, E for an extinguishment accounting. So what kind of accounting would apply? We pass the 10% test. And that's right, we get the extinguishment accounting. In this case, the old liability is going to be removed from the books of accounts. So extinguishment accounting would apply in this particular case. Okay. Now with this 10% test in hand, now what we need to do, we now need to pass the entries for the purpose of extinguishment accounting. So let's see the entry, which will be done on extinguishment. So financial liability, I'll put it in the brackets old, that is going to be derecognized at a book value, which is 10 lakhs. Financial liability, the new one is going to be recognized, and this is going to be at the fair value. Now, one thing which we need to be careful on, because many people do that common kind of mistake. Do not consider the fair value of this liability based on the step 2 calculations, because this fair value is not going to be taken on the basis of the calculations in step 2. You need the new EIR now, and the TC in this case is not to be taken. When you did the 10% test, you took the TC also into account, you took the original EIR into account, but when now you're going to do the calculations, the EIR is going to be the new one, and you're not going to consider the TC. The TC is going to be immediately expensed. So let's calculate the fair value at this particular stage. So we can say we are going to pay 50,000 interest. On 10 lakhs, the renegotiated interest is at the rate of 5%. We need PVIFA, which is at the new rate. And I guess if I consider the new rate is given to me, it's at the rate of 11%. So we need 11%, 7 years. Then we also got a repayment of 15 lakhs into PVIF. That's 11%, 7th year end. But we do not need to consider any TC in this stage. The fair value is only the interest and the principal repayments. So let's take at 11%. 1, 2, 3, 4, 5, 6, 7. This is 0.482, seventh year factor. This is 4.712 cumulative factor for a period of 7 years. So 0.482 into 15 lakhs, this is 723. So this comes to 958,600 is the total. And we're getting a balancing figure in this case. And where will you take the balancing figure? Arising on the extinguishment of the liability. Can I say there becomes a gain or loss, which is going to be taken in the P&L? So let's see the balancing figure. That's 41,400 is the balancing figure. And apart from this, we also need to do another entry as well. The transaction cost which is incurred is also going to be recorded. That is 1 lakh. And this transaction cost will be taken in the profit and loss account. So two separate entries done. One is the entry for derecognition of the old financial liability and the recognition of the new financial liability. The difference is the gain or loss arising on a derecognition, and then the transaction cost is expensed off in the P&L. Done. So this is on the derecognition of financial liability. I don't remember looking at any full-fledged questions in terms of derecognition of financial assets, so I've not taken that in the Super 20 questions. I've just taken the concept of derecognitions of financial liability. Okay, now let's come to another interesting area, hedge accounting. Let's do a question on the concept of hedge accounting with you. This is a little underrated area, I would say. If you look at more from the examination point of view, I don't remember much looking at questions on the hedge accounting, but I always have my expectations on. So let's, I think, go to the next area with you. You can try the question number 16. It is absolutely in the civil lines like question 15. It's an examination question, December 21. Okay, I think let's now come to the concept of hedge accounting with you, which is interesting question. This is something new. This question you may not have done this as well. I've just taken something different for the purpose of hedge accounting. Now it says on 31st October X1. I think first let's look at the input, the details which are given in the question, and then I think we'll solve. So discuss the accounting treatment of the hedge in the year ended December X1. Outline the accounting treatment for the inventory sale and the futures contract settled on March X2. So I think it's a complete accounting. We need accounting on December X1. And we also need accounting on 31st March X2. Now let's look at the inputs details of the question. It says on 31st October X1, Bling had got inventories of gold, which is costing 6.4 million to buy and which could be sold at 7.7 million. So the cost of the inventory is given and the fair value of the inventory is given. The management of Bling is concerned about the risk of fluctuations in the future cash inflows from the sale of the gold. I think the concern itself is indicating towards what kind of hedge would that be. A bit early, but I think let me still ask you, is this going to be a fair value hedge or is this going to be a cash flow hedge? Considering the concerns of the management is given that they are concerned about the risk of fluctuations in the cash inflow from the sale of the gold. I think it's very clear it is going to be a case of, you can say, a cash flow hedge. And that's rightly given, absolutely correct. Okay, then I am given to mitigate this risk, Blink entered into a futures contract on 31st October X1 to sell the gold for 7.7 million. The contract matures on 31st March X2. So they've entered into a derivative contract, and that is on 31st October X1, same date. Then he says the maturity of this derivative contract is March X2. The hedging relationship is designated and documented at inception as a cash flow hedge. All the effective criteria has also been met. So that means all the inputs, the requirements which are required in terms of a hedge accounting is met. So we are saying the effectiveness criteria is met, the documentations, everything is done. Then he says at the balance sheet date on December X1, the fair value of the gold is 8.6 million and the fair value of the futures is fallen by 0.9 million. So the fair value movements of the gold, which is supposed to be the hedged item, and the fair value movements of the derivative is all given. There is no change in the fair value of the gold and the futures contract between December 31st and 31st March X2. It says from the balance sheet date till the date of settlement, there has been no changes. On 31st March X2, inventory is sold at a fair value and the futures contract is settled net with the bank. I think let's quickly have a look at some data before we start solving this question. So you can notice that on October X1, though my balance sheet is ending on December, by the way, on October X1, they had inventory, the cost and the fair value is given. Then they entered into a futures contract on the same day, 1st October, which is going to be settled on March X2. December ending, gold value and the futures value is given. No changes in the fair value between December to 31st March. And then finally on 31st March, you sold inventory and the futures contract is being net settled as well. Okay, I think what I'll do first of all, I'll organize all this information in a chart and then it'll be easy to solve this question. This is a new question which is there. You might not have done this question because it's not one of the questions in the examinations or in the RTP, something different. It's good to sometimes handle a new question as well. Let's, I think, organize the data. I'm going to first of all just pen down the data which is given in the question. So we are doing question number 19. And I think let me just clearly make a mention that this is a cash flow hedge. This is a cash flow hedge. And I just want to organize the inputs in terms of a timeline. October, December balance sheet date, March X2 settlements taking place. So it's better to organize things on a timeline. That will be the easy way to organize the data. So if you look at the financial year is ending on December X1, that means it is starting on January X1. And 1st October X1 is when you entered the futures contract. So this is the balance sheet date. And this is 31st March X2. This is the date of settlement of the futures contract and when you made the sale of the inventory. So let's organize all the information in a single go and then we'll solve the entries with you. So let me just organize the data. So I'll just, give you the inputs once again on the screen. If you want, maybe you can just take a snapshot. If you've not downloaded the assignment, then maybe you can just quickly take a snapshot so that the data is in front of you. Because I'm just going to organize things on a timeline and then we'll start solving. Okay, I hope you've taken a snapshot of the screen. So let's start organizing the inputs now in this case. It says on 31st October X1, the company had inventories of gold. So I'm given that on 1st October, we had inventories of gold. And I am given the status regarding the inventory of gold. The cost is supposed to be 6.4 million. The cost of this inventory is 6.4 million. And it can be sold at 7.7. So the fair value is supposed to be 7.7. And then it says the management is concerned about fluctuations in the sale of gold. That's okay. To mitigate, they entered into a futures contract on the same date. So I think let me just segregate the data. So the company entered into a futures contract. The company entered into a futures contract. And it says this is a contract which is entered at it says to sell the gold at 7.7. So this was a futures contract to sell at 7.7 million. Right, then it says the contract will mature on 31st March. I think that we have already taken a note that it is going to get settled on 31st March. Then he says on December X1, the fair value of the gold is given. So I'm also given the fair value of the gold on the balance sheet date, and that is supposed to be 8.6 million. And I'm also given the fair value of the futures contract is fallen down by 0.9. So there is a decrease to the extent of 0.9 million as far as futures is concerned. There has been no change in the fair value of the gold and the futures contract between these two dates. So no change in fair value. There has been no change in the fair value during this particular block. I just noted down the data. And then it says finally that on 31st March X2, the inventory is sold and the contract is settled. So on this date, what we did, we sold the inventory is sold, and the futures contract is settled. The futures contract is settled on these dates. So on 31st March, these are the two events which have taken place. Now the question is asking you to do the entries on December X1 as also the entries which are done for 31st March X2. Great. So I think all the data stands organized. I think now time to put some quick questions to you at this stage. So we have the 1st October X1. That's the date of entering the contract, then on the balance sheet date, and then on the date of settlement, the transactions happening. First of all, I think one thing which you can clearly identify, can I say this inventory is supposed to be the hedged item? Am I right? This inventory is supposed to be the hedged item. And can I say the futures contract is supposed to be the hedging instrument? That is a derivative. And this derivative is supposed to be the hedging instrument in this particular case. Okay. Now, let's ask you a quick question. When you look at a cash flow hedge, is the hedged item on the balance sheet date carried at a fair value, or does the usual accounting apply? I'm looking at the hedged item. So when you're looking at the hedged item, do you consider the hedged item at a fair value, or is the hedged item continued at a normal accounting? So am I going to consider the inventory at cost or NRV, whichever is less, or am I going to consider the inventory at a fair value on the balance sheet date? So any inputs of that inventory, which is the hedged item, will be captured based on Index 2, or will it be taken at a fair value? In terms of fair value hedge, of course, we take the items at a fair value. But in terms of cash flow hedge, I think, let me answer, we continue with Index 2 itself. No fair value accounting in this particular case. No fair value. So let's, I think, concentrate on the entries on 1st October X1. So can I say the day you entered into the futures contract, there will be no entry? Because if you square off a derivative contract, which is on the date of entering the contract, there are no entries. The fair value gain or loss is always zero. So no entries will be done at the time of entering into the futures contract. Done. Now let's go further. Since it is a cash flow hedge, you would recall that you need to make a comparison between the fair value change of the item and the fair value change of the hedging instrument. And by making a comparison, you will be able to know how much difference is being taken in the OCI, which is called the effective portion of the hedge, and how much portion is taken in the P&L, which is called the ineffective portion of the hedge. So what you need to do on the balance sheet date is compare the fair value change of the hedged item vis-a-vis the fair value change of the hedging instrument. We do not account for the fair value change of the item. It is only for the comparison point of view. So I think if I look at the fair value change, in this particular case, what is the fair value change? From 7.7, it became 8.6. So there is an increase to the extent of 0.9. And if you notice, the fair value change in this particular case for the hedging instrument is also 0.9. So what you need to do, you need to come change of the item, and you need to compare the fair value change of the hedging instrument, and it is equal. So what do you say? Is this effective or is this partly effective, ineffective? The fair value change of the item is exactly equal to fair value change of the instrument. So is this going to be effective or partly effective, ineffective in nature? Of course, it is completely effective in nature. You need to see that if the fair value change of this particular hedge item is more than this, then you can say that there is supposed to be effective, ineffective portions to be identified. But in this case, it is exactly equal. So this is completely effective portion of the hedge. And if it is an effective portion of the hedge, then in this particular case, what you need to do, transfer the entire amount to the other comprehensive income. So in this particular case, is this a gain or is this a loss? This is a gain and this is a loss. Would you like to tell me, am I going to debit the OCI or am I going to credit the OCI? The loss arising on account of a derivative would create a financial liability. A gain arising on a derivative, that is hedging instrument, will give rise to financial asset. In this particular case, I am getting a loss on account of a derivative instrument. So this is going to be a loss. So we will debit the OCI, and this is going to be called as cash flow hedge reserve, because when you're going to show this amount in the, you can say, tab number 3 of SOKI, the amount to be shown in the tab number 3 of SOKI will appear as a cash flow hedge reserve. So this amount in the OCI will be debited, and this is called the cash flow hedge reserve, and the financial liability will get a credit, and that is to the extent of 0.9 million. So we need to compare the fair value changes of the item versus the instrument. In this case, the fair value change of the item instrument is common. So that gives rise to, you can say, effective portion of the hedge. It will be taken completely in OCI, and from the OCI, it goes in SOKI in tab number 3, which is called a cash flow hedge reserve. A quick question again, though I don't know if I'm going to get answers on this or not. Is this amount of OCI R or is it NR? Is this amount which you're taking in the other comprehensive income, is it with recycling or no recycling? And that's rightly said. It is, of course, indeed recycling in nature. Great. And then if you notice, there has been no changes in the fair value. If there has been no changes in the fair value, there is nothing to be compared. So we don't need to put any entry for a comparison of the fair values. But now we just need to record the sale of the inventory and the settlement of the futures contract. So let's see the entries for the sale of the inventory. So let's see what will be the entries for sale of inventory. So there are two things to be done. We need to capture the sale of inventory, that is 1. And we need to record the settlement of the futures contract, that is 2. So two things needs to be taken: settlement of the futures contract and the sale of the inventory in this case. So let's begin with, first of all, the sale of the inventory. So in terms of the sale of the inventory, we are considering the sale of the inventory. In this case, we put the entry bank gets a debit, or you can say trade receivable gets a debit, and the sale gets a credit. The inventory will be sold, of course, at a fair value, and there has been no change in the fair value at the end of the year as well as on the rate of sale. So it remains at 8.6. So the inventory is sold at 8.6. We also need to capture the cost of sale as well. The cost of sales will be given a debit and the inventories will be given a credit. And this is going to be with the cost of the inventory sold. And the cost of the inventory is 6.4. So we capture the cost as well. So this is with the selling price, and this is with the cost price at which the entries is recorded for the sale of the inventory. So the sale of the inventory is recorded and the cost of the sales is also recorded. This is done. Now we need to settle the futures contract. So in terms of the futures contract, what we need to do, the financial liability will be settled by making a payment. So we put the entry financial liability gets a debit and the bank gets a credit. and the financial liability is settled at 0.9. But then the only question which comes into the mind is, what do we do with this OCI debit balance? You tell me, if this is a case of recycling, can I say this amount is going to be transferred in the P&L? And can I say, since the entire inventory has been sold, can I transfer the entire amount in this cash flow hedge reserve in the P&L in the year of sale itself? Yes. Because as and when the hedged item enters the income statement, this amount is also taken in the income statement, recycled in the P&L. So we're going to put the entry profit and loss gets a debit, and the OCI, that is cash flow hedge reserve, gets a credit, and this is to the extent of 0.9. This is what we're doing is a case of recycling. Okay, wonderful indeed. So I think this takes care of the entries as far as the hedge is concerned, the cash flow hedge is concerned. Now, I think I just want to make a quick mind map at this stage, though I've not done a questions on a fair value hedge, but I think I'll still make a quick mind map on the concept of the accounting for a fair value and a cash flow hedge so that you can keep some basic dots connected in the mind. So let's make another mind map as well. So this is what I'm doing for hedge accounting. And we know that there are basically two kinds of accounting, though there are three, but basically focus is on the fair value hedge as well as on the cash flow hedge, that what are the nitty-gritties to be done. So segregate this in terms of two elements. One is the fair value hedge and one is the cash flow hedge. And I think I'll definitely like to put some questions as we make the mind map now, so that we get a comparative picture of the fair value and the cash flow hedge very clear. So my mind is now working in terms of the focus points, entries, you can say at the inception. So first, I think let's put down one thing, hedged item and hedging instrument. These are the two focus points, whether they are captured at what value. Then I'm looking at the entry when you enter into a derivative contract. And I'm looking at entries, let's say on the balance sheet date. I'm not looking at the settlement date. So this is a basic picture which is coming to the mind. Now let's put some questions to you, point blank, you can vouch me. Can I say in a fair value hedge, the hedged item and the hedging instruments both are recorded at a fair value, except one exception, correct? So whether it is the hedged item or it is the hedging instrument, can I say both these items are captured at a fair value, except if the hedged item is equity investments measured at FPT-OCI, right? This is captured at a fair value, this is captured at a fair value, and the only exception in this particular case, the only exception is if you've got equity investments which are measured at FPT-OCI, no recycling, then the differences are taken in the OCI. So in these cases, the fair value changes are all captured in the P&L. The fair value changes of the item, the fair value changes of the instrument, both are taken at a fair value and the changes are taken in the P&L. And this is the exception where the fair value changes in this case is taken both in terms of OCI, right? So this is one input. Now, in terms of the cash flow hedge, when it comes to the hedged item, do you capture at a fair value? No. For the hedged item, the usual accounting applies. There is no concept of fair value in this case. It is only the hedging instrument is taken at a fair value. And where do you take the fair value changes? So I think let's pen this down as well. When you look at the fair value changes in this case, you need to filter what is the effective portion and you need to filter what is the ineffective portion. The effective portion enters the other comprehensive income and the ineffective portion enters the P&L. So you need to remember that in this case, the fair value changes a split between the effective and the ineffective portions by making comparisons. The fair value change of the hedge item is compared with the fair value changes of the hedging instruments, and then accordingly you decide the effective and the ineffective portions, and they are accordingly taken in the OCI and the P&L. Let's now go entry. The day you enter the contract, no entry. Here also, the day you enter the contract, there is no entry. We do not put any entries the day you enter the contract, no entries are done. Now, on the balance sheet date, we've already seen this, but just to reiterate, can I say the hedged item and the hedging instrument? So both these items are captured at fair value, and where the fair value changes are entered in the P&L with the exceptions. And on the balance sheet date, it is only the fair value changes of the instrument which is captured. It is only the fair value changes of the instrument which is captured at a fair value. The hedge item is not captured at a fair value, and this difference is taken in the OCI or the P&L, depending it is effective, ineffective in nature. So this is a quick mind map in terms of the hedge accounting. What do you do when it is a fair value hedge, and what do you do when it is supposed to be a cash flow hedge? Right, friends. So I think that is on hedge accounting. Now I just want to come back to one question which I left intentionally. I thought I may not run lack of time. I want to now do a special case of accounting financial guarantee with you, because I think that is one another area which was I think came in the RTPs I think almost once or twice, or maybe in the exam as well. So let's do one special case of accounting of financial liabilities before we close on financial instruments, because that is one area I think which can be very important indeed. So let me, I think, share the question to you. Let's go back a little. 20th question again I put on the hedging itself. So let's, I think, come back to the question number 14. That is a question which came twice, one in RTP in May 2021, and one is in the MTP, and that was in 21 again. So I think this is one case which I think we should definitely do. So let's have a look at this particular case. Let me just read the facts to you. This is on a financial guarantee. It says provide the accounting treatment of a financial guarantee as per 109 in the books of Sun on initial recognition and the subsequent period, that is till 31st March X3. So we're asked the accounting at the initial as well as at the subsequent accounting, that is till March X3. Now let's read the facts of the case. It says on 1st April X1, Sun guarantees a loan of a subsidiary that is given to Moon, which the bank provided Moon for 3 years at the rate of 8%. The interest payments are made at the end of each year, and the principal is repaid at the end of the term loan. So it's a bullet repayment of the principal, but as far as the interest is concerned, it is being paid on annual basis at the end of each year. If Sun had not issued a guarantee, the bank would have charged Moon an interest rate at the rate of 11%, which means the bank gave the loan to the subsidiary at the rate of 8%. But if the financial guarantee was not there, they would have given the loan at the rate of 11% in that case. On 31st March X2, there is a 1% probability that Moon may default on the loan in the next 12 months. And a Moon defaults on the loan, Sun does not expect to recover any amount from the subsidiary. And then similarly on 31st March X2, there is a 3% probability that Moon may default on the loan in the next 12 months. A Moon defaults, Sun will not get any recovery again from Moon. So we given the probability of default at the end of second year, at the end of first year, and at the end of second year. And then it says further that the requirement is again accounting treatment for the year ending March X3. So we are required to do the accounting for the end of first year and at the end of second year. So I think this will also indirectly take case of a bit of the calculations on impairment loss, because you know that in terms of financial guarantee, when you are considering the amount of provisions, you need to consider higher, lower, whatever of what. So indirectly, the impairment calculations will also indirectly get taken care in this. So let's, I think, begin the journey. Question number 14. So let's have a look at question number 14. That is a special issue in terms of accounting for a financial guarantee. So I think still ask you a question, though I know I may not get answers on that, but I think still let's put a question to you. Can I say the first instance, whenever it comes to recording a financial asset or a financial liability, as I've been saying throughout the lecture today, that you need to first of all calculate a fair value. Because whether it's a financial asset or any financial liability, with the exceptions of course, it is capturing the fair value of the liability. And in this particular case, how would you calculate a fair value? The bank gave a loan to the subsidiary at the rate of 8%. Had there been no guarantee, they would have given interest at the rate of 11%. So you can say that there is a 3% differential in the interest rate. So we can say the advantage which the parent company is giving to the subsidiary company is the reduction of the 3% interest on the loan. Because without the guarantee, it would have been 11, and with the guarantee, it is 8. So there is a 3%, you can say, benefit given. So we can say the financial guarantee will be again captured at the fair value. So we need to compute the fair value. So we can say, what is the loan figure? The loan is to the extent of 10 lakhs. So we can say the differential 11% minus 8% is the benefits. And let's multiply this with the 3 years factor, the cumulative factor for 3 years. And this is going to be at the rate of 11% for a period of 3 years. The fair value of the guarantee is supposed to be the benefit which the parent gave to the subsidiary, 3%. So let's get the cumulative factor, 11%. 1, 2, 3. This is 2.444. So on 10 lakhs, there is a 3% benefit into 2.444. This is, I think, coming to 73,320. That becomes the fair value of the guarantee. So the amount at which we will record the financial guarantee at a fair value is the difference in the interest had there been no guarantee versus the interest had there been a guarantee. So this is indirectly the benefit which the parent gave to the subsidiary company in a monetary value. So let's now also see the journal entry at the initial recognition. Would you like to help me with the journal entry at the initial recognition? What is the entry? What is the account which will be debited? Of course, credit is the financial guarantee, financial liability. Which account will you debit? I'll give the financial guarantee as a credit. So this is 73,320. Any inputs on what is going to be a debit side? So what is the ledger account which you're going to debit in this case? I think let me put this investment in subsidiary. The investment in the subsidiary company gets a debit and the financial guarantee gets a credit. Now we need to see the accounting of this financial guarantee for the next 2 years to come. So let's have a look on the accounting of this guarantee subsequently. So I think for this purpose, it will be a good idea to make a ledger account for the period of next 2 years. That is the financial liability, financial guarantee account. Let's make a ledger account for the next 2 years to go. You need to make exactly a same kind of ledger account as if you're preparing a financial guarantee, financial liability at AC. But once you've done this, then we need to make some comparisons. We'll do that. First, let's concentrate on the AC accounting. So this is investment 73,320. And we consider the finance charge at the rate of 11% on this. So let's see, 11%, 73,320 into 11%, 8065. And each year you're passing on the benefit, that is 30,000. That 30,000 is nothing but the differential interest, that is 3% of 10 lakhs. Every year you're passing on the benefit to the subsidiary. They're getting a benefit of 30,000 because of the 3% differential. Let's get the balance CD balancing figure. Surplus 086. This is 51385. I'm just making this ledger account in the background because this will be required for the purpose of looking at each year end entries. But first, we're just making a background, working out this at AC. This becomes the balance BD, 51,385. Let's again take the finance charge at the rate of 11%. That's, I think, 5652. And again, the benefits, that is 30,000. So we get the balance CD as a balancing figure, 51,385, 5652. This, I think, comes to 27037. I think now, let me put one more question to you at this particular stage. Financial guarantees at each year end is measured at what value? When you consider the financial guarantees at the end of the year, they are going to be measured at what value? First of all, just tell me higher of the two, lower of the two. I'll tell you what are the two, but do we take higher of the two or lower of the two? I think let's get at least that answer. So what is the value at which financial liabilities are taken at each year end? Lower of the two, higher of the two? I don't think so. I'm going to get answer on that. Let me, I think, answer that itself. Today, it's, entirely me answering questions, I guess. Okay, so it is supposed to be the higher of the two. You need to take what is the amortized cost value, and you need to take that if there is an impairment. If there is an impairment, then what is the expected credit loss in this particular case? So you need to consider the higher of the two. What is the value based on amortized cost and the impairment? Now, I guess in terms of impairment, it very clearly said on March X2, there is a 1% default in probability. So if the impairment is calculated, there is a 1% probability of default that you're not going to get this money. So 1% comes to 10,000. And the amortized cost is 51,385. This is at the end of first year. This is the amortized cost value. And this is the expected credit loss. If the loan is not repaid, we need to record it at the higher of the two. So if you need to record this at the higher of the two, then you need to bring this financial liability down. So we can decrease the financial liability, the financial guarantee. That is, financial liability gets a debit and the profit and loss gets a credit. The difference will get adjusted at this stage. 73,320 minus 51,385. So we will take 21,935 in the profit and loss, which is a remeasurement of this liability at the end of the first year. Same exercise is going to be repeated at the end of the second year as well. So I think in the end of second year, let me make the calculations here itself. This is 27037. And the probability of default, I think, is changed to 3%. So this will become 30,000. So you need to record at the higher of the two. So now you need to compare these two figures. So the entry is a reduction. Again, financial guarantee. That is, financial liability gets a debit and the P&L gets a credit. So now you need to bring this value down to 30,000. So the difference is 21,385. This is the financial guarantee remeasured at the end of each year. This is at the end of first year, and this is at the end of second year, remeasurement of the financial guarantee. Right, friends. So I think that captures the accounting for financial guarantees as well. So out of the special issues I've done, the hedge accounting as well, the derecognitions as well. I did not take questions on the impairment exclusively because I think on the impairment it's not very difficult because it's just an application of multiplying four variables. You just need to consider the three factors into account. You consider the exposure at default, multiply it with the loss given default and the amount of probability of default, and if the time value money becomes relevant, that is also taken. And it doesn't get tricky because all those informations are very clearly given in the question. So I did not intentionally take questions on that area, so I think that questions can be done, but I think more or less we've tried to cover the maximum in terms of all the technical issues and impairment. So now if you just map your mind in terms of financial instruments, you will realize that we have covered the areas in terms of compound financial instruments, which is the main component of Index 32. Then we went to the accounting of financial assets and liabilities with all the permutations, combinations, typically the amortized cost and the fair value through OCI. We picked up two special issues in that case. One is the difference in transaction value and fair value differences, and the concept of prepayments of loans. That was a special issue. Then comes the derecognitions concept, and then comes the impairment concept, and then comes the hedge accounting concept. That's how the entire mind gets mapped up in terms of this. So I think that brings us to the end of the revisions on financial instruments. Our next area of focus of revisions is going to be on the consolidation standards, where we're going to spend time on Index 103, followed by Index 110, as well as Index 28. And I'm planning, to take a comprehensive questions in terms of balance sheet and in terms of P&L as well. Something, which is different, where you get a flair of different kind of adjustments, like, a concept of a deferred tax along with consolidations and all. What do you say? Is that a good idea? Then I can, maybe include some questions on that area as well. A full-fledged questions considering all the kinds of permutations, combinations. I might, just land up doing the questions on my own on that day. So I'm a little skeptical on that area. But still, what do you say? Good idea to take that questions, which is going to be, we're going to spend almost like 1 hour doing that kind of questions, but it contains all the kinds of permutation, combinations of consolidation adjustments. Very good idea indeed. Great, brilliant. Right, friends. So I think that brings us to the end of the inputs for the day. Any questions on your side? Thank you, Prashant. Thank you very much indeed. So I think that's all for the day, friends. So we're going to see you in the next session. Thank you. Bye-bye. Take care. Anji, thank you.